Navigating frontiers. Key differences between investing in developed and emerging market economies. Introduction. In the realm of global investing, the choice between developed and emerging market economies is a pivotal decision that can shape the trajectory of investment portfolios. The dichotomy between these two categories extends far beyond mere geographical distinctions, encompassing diverse economic, regulatory, and risk factors. Understanding the key differences between investing in developed and emerging markets is essential for investors seeking to navigate the intricate terrain of international investments. Economic maturation and growth trajectories. At the core of the distinction lies the level of economic development. Developed economies, characterized by advanced infrastructure, established institutions, and mature financial markets, boast a more stable and predictable investment environment. These economies typically experience slower but steadier growth, with a focus on innovation, technological advancements, and service-oriented industries. Conversely, emerging market economies are in the nascent stages of development, marked by rapid growth, evolving institutions, and a shift from agrarian to industrial and service sectors. While emerging markets present the allure of high growth potential, they are often susceptible to greater volatility due to factors such as political instability, regulatory uncertainties, and less mature financial systems. Market size and liquidity. The sheer size and liquidity of financial markets differ significantly between developed and emerging economies. Developed markets, such as those in the United States, Europe, and Japan, tend to have larger and more liquid markets, providing investors with ample opportunities to buy and sell securities without significantly impacting prices. In contrast, emerging markets may have smaller and less liquid markets, which can result in higher bid-ask spreads and increased price volatility. Investors must exercise caution and employ strategic approaches when navigating these markets to mitigate liquidity-related risks. Regulatory environment and investor protections. The regulatory framework governing financial markets varies widely between developed and emerging economies. Developed markets often boast robust regulatory structures, stringent disclosure requirements, and well-established investor protection mechanisms. These factors contribute to greater transparency and confidence among investors, fostering a sense of security in the regulatory environment. On the other hand, emerging markets may grapple with regulatory challenges, including gaps in enforcement, limited transparency, and varying levels of legal protections for investors. Navigating these regulatory landscapes demands thorough due diligence to assess the adequacy of investor safeguards and the reliability of financial information. Currency risks and exchange rate volatility. Currency dynamics play a pivotal role in international investing, and the risk associated with currency fluctuations is pronounced in emerging markets. Many emerging market currencies can be more volatile than their counterparts in developed economies, subjecting investors to additional risks. Exchange rate movements can significantly impact the returns of foreign investments, potentially amplifying gains or losses. Investors in developed markets may experience currency risk to a lesser extent, as currencies like the US dollar, euro, or Japanese yen are considered relatively stable. However, in an increasingly interconnected global economy, even investors in developed markets must remain vigilant to currency risks. Especially in times of economic uncertainty and geopolitical tensions. Political and geopolitical considerations. Political stability is a critical factor influencing investment decisions, and it diverges markedly between developed and emerging markets. Developed economies generally enjoy more stable political environments, with established democratic institutions, transparent governance, and a predictable rule of law. These attributes contribute to a lower perceived risk for investors. Emerging markets, however, may face political uncertainties, governance challenges, and geopolitical risks that can introduce a layer of complexity to investment decisions. Factors such as changes in leadership, policy shifts, or geopolitical tensions can impact the investment landscape and require investors to incorporate a geopolitical risk assessment into their decision-making processes. Sector composition and investment opportunities. The composition of industries and sectors within developed and emerging markets differs, influencing the nature of investment opportunities. Developed economies often feature a higher concentration of mature industries, technology-driven sectors, and service-oriented businesses. Investors seeking stability and dividends may find these markets attractive. Conversely, emerging markets may offer opportunities in industries poised for rapid growth, such as technology, telecommunications, and consumer goods. The demographic trends, urbanization, and rising middle class in many emerging markets create an environment conducive to dynamic economic expansion and provide a fertile ground for certain sectors to flourish. Conclusion. The decision to invest in developed or emerging markets is a nuanced choice that demands a thorough understanding of the unique dynamics at play in each category. Developed markets provide stability, liquidity, and well-established regulatory frameworks, appealing to risk-averse investors. In contrast, emerging markets beckon with the promise of high growth potential, albeit with increased volatility and a set of unique challenges. Ultimately, a well-balanced investment portfolio may incorporate elements of both developed and emerging markets, leveraging the strengths of each to create a diversified and resilient strategy. By carefully weighing the key differences outlined above, investors can navigate the frontiers of global markets with astuteness, ensuring that their investment decisions align with their risk tolerance, financial goals, and the ever-evolving landscape of international finance.